have a good day to everyone. I'm Khartiga and my matrix number is 06DAT23F1120. For my part, I will be discussing on the nature of non-current liabilities. What are non-current liabilities? Let's see. According to IAS 1, presentation of financial statements, non-current liabilities are defined as obligations that are not expected to be settled within the entity's normal operating cycle or within 12 months after the reporting period. These liabilities are not due for payment in the short term and are instead settled over a longer period, usually exceeding a year. Non-current liabilities, also known as long-term liabilities. These are shown in the Statement of Financial Position (SOFP) under liabilities, separate from current liabilities. And the following are examples of non-current liabilities: bonds, mortgages, long-term loans or borrowings. The nature of non-current liabilities are as follows. Firstly, long-term obligations. These liabilities represent financial obligations payable beyond 12 months from reporting date. These liabilities used to finance big investments like purchasing assets, expanding operations, or acquiring property. Examples include bank loans repayable over 5 years and long-term notes payable. Secondly, arise from past events. These liabilities are created by past transactions or actions. They indicate a present duty that must be settled in the future. For example, lawsuit damages and employee benefits. Thirdly, future economic outflow. The settlement of these liabilities needs cash or assets. The company gives up future benefits to meet the obligations. This can be seen in loan repayment or pension payment. In addition, the next point is not linked to operating cycle. Non-current liabilities are not expected to be settled within the company's operating cycle. They are usually tied to long-term financing or obligations. For example, a 10-year bank loan for equipment. The last one is measurement and recognition. Non-current liabilities are initially measured at fair value or present value. Their subsequent measurement depends on the type of liability, such as amortized cost for borrowings under IFRS 9. Example, a long-term loan is recorded at fair value and later measured at amortized cost.
Assalamualaikum, my name is Nurin Auni with metric number of F1138. I will start with the audit assertion for non-current liabilities. First is existent. This means the auditor must confirm that the liabilities recorded, such as loans or lease, actually exist and are not overstated. Second is completeness. Here, the auditor ensures that all non-current liabilities are included in the financial statement and that none are left out or hidden. Third is valuation and allocation. This checks whether the liabilities are measured correctly and properly classified between current and non-current portion. Lastly is obligation. This is to confirm that the company is legally responsible for the liabilities and not another party. So overall, this assertion gives assurance that non-current liabilities are real, complete, correctly valued, and truly the company's responsibility. Assalamualaikum, I am Nurin Auni binti Nur Azman with matrix number of F1138. I will explain the accounting treatment of non-current liabilities. First, long-term loans are recorded as non-current liabilities with interest charged in the income statement. Any part due within 12 months is shown as current liability. Second, debentures are recognized as the amount received and interest is treated as finance costs. At maturity, they are either repaid or converted. Third, lease liability is recorded at the present value of future lease payment, while a right of use asset is also recognized. Payments are split between interest and liability reduction. Lastly, deferred tax liability arises from temporary differences and is shown under non-current liabilities, with the related tax expenses recorded in the income statement. In short, these treatments ensure non-current liabilities are fairly presented in the financial statement.
6.3. The discussion on the accounting system and control activities related to non-current liability. First, I want to talk about the accounting system related to non-current liability. The first thing is initial recognition, that record the liability at fair value of the amount received, such as loan, bond proceed, and extra. And second thing is subsequent measurement. Split into current portion due within 12 months and non-current portion due after 12 months. And then interest expenses recognized using effective interest method or as per loan terms. So we can see the measurement of interest and extra measurement of accounting treatments. Number 3 is presentation in financial statement. First is under non-current liabilities, long-term borrowing, lease, obligation, deferred tax are the example of presentation in financial statement. And then we add some events in notes to the account, such as disclosed term, interest rate, repayment schedule, and security pledged. Last and final for accounting system is example of accounting system applied. There are 4 examples of accounting system. First, loan and borrowing system. Second, lease accounting, that is MFRS 16. Third, provision and pension accounting, that is MFRS 137. And finally, deferred tax accounting, that is MFRS 112. Next, I want to explain about control activities related to non-current liabilities. There are many control activities, but I want to explain 6 only in this slide. First is authorization control. All the agreement loans must be approved by board of director or senior level management before being recorded. Second is documentation control or documentation and verification. Maintain proper contract, loan agreement and supporting documents. Independent check to verify loan balance with bank confirmation. And third is segregation of duties. The example is different staff should handle loan approval, recording and payment to reduce fraud risk. And next is reconciliation and monitoring. Regularly checks the loan balance in the accounting system with bank statement or lender confirmation. Monitor due dates for repayment and interest payment to prevent default. Next is audit trail and review. Keep clear records of loan agreement, payment schedule and interest calculation to ensure every transaction is supported by documents. Regular internal or external audit to check accuracy and compliance. And final is risk management control. Assess risk of default, high interest cost or breaching loan covenant. Put limit on how much debt the company can take. Get board approval for new financing to avoid unnecessary liability.
Assalamualaikum, my name is Dinahan and my number matric is 06DAT23F1129. Now I will be talking about the relevant assertion for non-current liabilities. First is exist. The liability actually exists at the balance sheet date. That means checking if the liability shown in the books is real and not fake. For example, if the company show a long-term loan, the auditor check if there is an actual loan agreement with the bank. Second is valuation. Liabilities are recorded at correct amount, amortized cost or fair value. That means checking if the liability is accurately measured, not too high or too low. For example, if a bond is reported, the auditor checks if it is recorded at the correct value considering interest, amortized or fair value. After that, right and obligation. The company is legally obligation to pay the liability. Checking if the company has a legal obligation to pay it. For example, if a loan is recorded, the auditor check if the loan agreement is actually under the company's name and not someone else. Lastly, completeness. All non-current liabilities that should be recorded have been included. That means checking if the company has included all non-current liabilities in the books and not left any out. For example, if the company has another bank loan but forgot to record it, completeness is violated.
Assalamualaikum, my name is Amirul and I will continue a few more points from my friend regarding the assertion of non-current liabilities. The point is classification. Correctly distinguish between current and non-current portion. For example, portion of loan due between 12 months show as current liability as non-current liabilities. After that, accuracy. Amount and related expenses are correctly calculated. This means that the amount relating to mathematical correct, properly calculated and agree with supporting document is ensured. Interest, capital and less finance costs are recording at the right amount. And the last is presentation and disclosure. Properly describe and disclose in the notes as required by MFRS or IFRS. User of finance statement must clearly understand the nature, terms and risk of the liabilities. In the conclusion, non-current liabilities are accurate as they reflect a company's long-term liability commitment beyond the normal operating cycle. They arise from the past transaction, acquired purchase economic outflow, and the measure according to accounting standards such as MFRS or IFRS. For example, include borrowings, loans, pensions, and deferred tax. From an audit perspective, understand non-current liability is important because they directly affect solvency, leverage, and finance stability. Proper recognition, measurement, and disclosure ensure transparency and compliance with accounting standards. Auditor must evaluate supporting evidence and apply audit procedure to confirm that these liabilities are fairly presented in the final statement. That's all for me. Thank you.